And with all of the price declines that we are seeing out there, whether it's in retail because of too much inventory or way up the pipeline with commodities really falling out of bed, all of them, we think the inflation rate is going to be surprisingly low. We would not be surprised to see deflation month to month sequentially for a number of months during the next 6 months.
Does that mean that you are betting that the Fed eases up in a way that they have not signaled thus far?
Absolutely.
So you said you're in the notes at least about a Fed pivot, that this could happen. And I'm wondering, we were just discussing what that means now. I feel like it's lost all meaning. What in your view is a Fed pivot?
It's a soft pivot. It's a maybe pivot. What kind of pivot?
And they're going to make it clear at some point soon that they're close to the end.
So real quick, I think what the Treasury market has done with the rise in yields is no longer does the Federal Reserve, Scott, have the luxury of waiting to see if the rate hikes, the tightening of the balance sheet will bring down inflation. The market is telling them they can't wait any longer. And I think that is crystal clear right now. And that's why I think you will get a pause.
Yeah, I think there's going to be a pivot soon.
Our next guest suggests the market is underestimating odds of a Fed pivot. Nancy Davis is the Chief Investment Officer at Quadratic Capital Management. She runs the firm's interest rate volatility.
But now the move in the dollar is saying perhaps that's easing slightly, but more importantly, because the Fed, we can have line of sight to the Fed eventually going on pause, likely by year end. Big plus for assets.
So that, in a sense, depicts peak Fed hawkishness. That's the hope, right?
I don't think the Fed's going to have to go that high. I do expect one more increase of 75 basis points at the end of September, and that's when they might pause.
Even though CPI still looks pretty strong, I think the Fed would be happy to see any type of weakening in inflation, and I think that's coming. So I just think the odds are very good for investors.
I don't know. I mean,
stocks are rallying because Wall Street finally believes we're getting closer to the end of this nasty tightening cycle. That's why I have told you from the beginning to stay the course.
Kinder, gentler.
Let me say this. It is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go.
Well, I mean, I think David's been right. It's been tough to fight the Fed. And, you know, we've had a real tough time with our calls this year, but
I see you, I feel you.
All right. Today is Wednesday, November 2nd. This is a recap for the stock market activities today. And folks, I got a good one for you tonight, but boy, where do we start? How about we start with this? Here in this channel, we've been saying over and over and over again, no rally allowed. No rally allowed. Every time you're going to buy the dip, you're essentially fighting the Fed. And fighting the Fed is not a good strategy in a bull market or in a bear market. And why do we say that? Why do we say that no rally allowed? In essence, every time the stock market rallies higher, it loosens financial conditions. And it goes against the Fed's war against inflation. To tackle inflation, the Fed needs tighter financial conditions, and they need them to stay as tight as possible for as long as possible to add downward pressure on inflation and take it down. So every time the market buys the dip and rallies impulsively higher, it loosens financial conditions, making the Fed's job a lot difficult than before. So the Fed has to counter, and they have to come out even more aggressive than before. And of course, they hope that by coming out more aggressive, it's not going to be in raising rates more than before, but their statements alone will convey the message to the market. Stop buying the dips. And the latest example, of course, back in the summer, the market rallied impulsively in another bear market rally, and this bear market rally ended the moment The Fed Chairman Jerome Powell came out in Jackson Hole and said, expect more pain. The Dr. Pain speech. And the market did a 180 and went down. So far, so good for the Fed. Message received. But then the market started to bargain again. That, there was a reason to rally here. There was another reason to rally there. And maybe this and maybe that. And we know we're getting into the funny season. We have the midterms. We also have the last quarter of the year, and whether you know it or not, I happen to be a portfolio manager, and I know that we don't make money unless the market goes higher. We don't get these massive fat bonuses if the stock market doesn't go higher. We only have 1 quarter left here, so all of a sudden you have these money managers coming out of the woodwork all over TV saying, the stock market will go higher because of this or because of that. It's time to buy, regardless of the facts, regardless of how bad earnings were, and regardless of the Fed's stance on fighting inflation. And the latest excuse that they found out is, the Fed, forget about what the Fed says. The Fed is lying. The Fed is going to pivot either way. It's not up to them. And did we say that the pivot is cutting rates? Forget about that. That's not going to happen. And did we say that by a pivot we mean the Fed will pause raising rates? Forget about that. We're not going to say that anymore. What we mean by a pivot right now is, the Fed is going to slow down the rate of interest rate hikes from 75 to 50. And that is a reason for the market to rally higher. And of course, in this channel, we showed you the facts and the data. And what Chairman Powell said in the last meeting, he acknowledges that at some point, there's going to be a pivot. If this is the latest and most accurate definition of a pivot, yes, he's going to slow down the pace of interest rate hikes. But there are conditions for him to do that, and he outlaid the conditions clearly. And the most important condition is for inflation to go down, but most importantly for it to be clear that the trajectory for inflation is down, that it's not going to be the case when they release their foot from the accelerator that inflation is going to pop higher again. They cannot afford to do that. They're already too late to the game. And I've shared with you multiple pieces of data that show inflation is not going down. We're not seeing softening in the labor market. Wage inflation continues to go higher. Core inflation continues to go higher. And there is absolutely no ground for a Fed pivot, whatever the definition may be, at all. And today we got yet another piece of data in the morning, the ADP report, with private payrolls going higher by 239,000 jobs in October. And listen to this, wages went higher by 7.7%. So again, we're seeing a hot labor market, at least for now, and it comes with higher wages. Higher wages will push inflation expectations higher, and therefore inflation will continue to go higher and higher and higher. So the Fed will have to become more aggressive. That is the real pivot, when the Fed acknowledges and realizes that, hey, there's a lot more ground to cover here, and they need to be more aggressive and up the pace of interest rate hikes, not take them down. But of course, Team Pivot, formerly known as Team Transitory, didn't want to listen to the logic, to the reason, to the facts, and they just feel the Fed has to do whatever they want because they start to cry and bark that their portfolios are down. The politicians start to bark because they're about to lose their seats, and they add pressure on the Fed. Hey, you gotta ease it down, Mr. Powell. But Mr. Powell got a job to do, and his job is to take inflation down. And he doesn't see anything in the data that merits him to take the pace or to slow down the pace of interest rate hikes. None at all. And look, we are now at the stage in this bear market where the bulls are now bargaining. We know we have stages of grief: denial, anger, bargaining, depression, and then acceptance. Market bulls are still stuck in QE mentality. They still believe that this is a pullback, a correction, and then the Fed will come to the rescue, pump the stock market higher again, and we will have a V-shaped recovery, and the equities market will make a higher high, all-time high, in no time. And they're afraid of FOMO, the fear of missing out, that they're going to miss the opportunity. They haven't gotten the memo yet. The regime of QE is over now. We have a new regime, a seismic shift in financial markets, the likes that we've never seen before. Get the memo. But again, these are the stages of grief. And we can, of course, dabble around whether it is denial or bargaining right now. Some would say in the beginning they were in denial. They said initially that it doesn't matter if the Fed increases interest rates because the economy is pretty strong. We're going to have a soft landing where the Fed takes inflation down, but the economy remains intact. And then came the anger as the stock market continued to go down. Every relief rally, so-called bear market rally, ended in a U-turn and a lower low. And then they came with the bargaining. Okay, Mr. Powell, we're not going to say cut rates. We're not going to say pause. We're just saying slow down the pace of interest rate hikes. So now, after he shut down all of this today, are they going to come out with a depression? It's all done now. The stock market is going to crash. It's over. Or, as some believe, are they still in the denial stage? And now we're about to see the anger. Or the chairman of the Fed, Jerome Powell, is looking to destroy the economy. The chairman of the Fed intentionally wants to see job losses. He's the enemy of the people. The same thing they said about Paul Volcker back in the day. Now they're saying the same about Jerome Powell. And look, I'm not a fan of Jerome Powell. I criticized him for years. And he is responsible for this inflation. And all what he's doing right now is cleaning his own mess. And of course, we're going to pay the price. The stock market is paying the price. Retirees are paying the price. The entire economy will pay the price. But we are here now, and we must take inflation down. We cannot let inflation continue to go. That would be disastrous for the economy, for employees, for everything. Read history. Every time inflation was just let go, who cares about inflation? That brought down empires. And it will indeed bring down this country and the global economy if we continue to let inflation go. The fight must happen, and the price to pay will be dire. Nobody's denying that. But most importantly, market participants need to wake up. They need to realize what's going on in this economy and the reality of what's about to happen. We are getting out of a decade plus worth of financial engineering, worth of the most reckless financial decision ever, quantitative easing, which got us out of the financial crisis back in 2009. But they didn't stop. Once the economy normalized, they continued easing, they continued printing money like crazy. Everybody was borrowing money, expanding businesses, investors, be it venture or angel investors, throwing cash at the dumbest ideas ever. Valuations are sky high, don't make sense at all. Companies, individuals, businesses taking unneeded risk, racking up loads of debt on their balance sheets. The government spending, racking up deficits year after year after year, with the assumption that, hey, maybe this is the new normal. Maybe we don't need a normalized monetary policy. Maybe we can keep interest rates at around zero forever and have the Fed print unlimited amount of cash all over the economy. Everybody can live beyond their means, and everybody's going to live happily ever after. And of course, then came inflation. The genie is out of the bottle now. We have to undo a decade plus worth of risk-taking in the economy. And some would argue, and I certainly see it that way, after a decade plus of quantitative easing, all of this risk-taking in the economy produced cancer in the body of the economy. And this cancer is spread all over the place in the body of this economy. To take this cancer out, the treatment is going to be really, really aggressive. It's not just going to damage the malignant cells, but also the benign ones. And it might indeed end up killing the patient. This is a historic event that we're living in right now. This is a story that we're going to tell our kids and our grandkids and the next generation. The greatest financial engineering experiment in history is now done. And we're just seeing the ramifications of this financial engineering. We have been accustomed for years to expect the happy ending, that it's all going to be all right at the end of the day. There is always a savior, and the savior we're accustomed to is the Fed. But what if this story doesn't have a happy ending? What if this story ends up tragically, just like it did back in the 1920s, with the crash of '29 and the Great Depression that followed thereafter? What makes you think that this time around the story is going to end up with a happy ending? That the Fed will come to the rescue, stock market bottoms, we make all-time highs, nobody loses their jobs, and everybody lives happily ever after? What if that doesn't happen? Again, we're accustomed to the happy ending because we've never seen bad times in this country, unless you lived in the Great Depression or the aftermath of the Great Inflation in the 1970s. But the majority of Americans have not seen bad times at all. The Great Financial Crisis was the closest they have experienced, but the Fed came to the rescue, and the bailouts were all over the place, and we got out of that hole. But there was a price to pay, and we're now paying this price. And I love this piece for Market Watch, written by Mark Hubbard. It reads, "Stock market bulls have a new story to sell you. Don't believe them. They're just in the bargaining stage of grief." Listen to this. At the market's recent closing low, the S&P 500 SPX had dropped to 25% below its early January high. According to one version of this "so bad it's good" quote-unquote argument, the stock market in the past was a good buy whenever bear markets fell to that threshold. Following those prior occasions, they contended the market was almost always higher in a year's time. This is not an argument you'd normally expect to see if the recent low represented the final low of the bear market. On the contrary, it fits squarely within the third of the 5-stage progression of bear market grief, about which I've written before. denial, anger, bargaining, depression, and acceptance. With their argument, the bulls are trying to convince themselves that they can survive the bear market, rationalizing that the market will be higher in years' time. As Swiss-American psychiatrist Elizabeth Kubler-Ross put it when creating this 5-stage scheme, the key feature of the bargaining stage is that it is a defense against feeling pain. We all remember when somebody significant broke up with us, right? Maybe she's going to come back. Maybe if I change something, she's coming back. No, she's not coming back. It's over. She's banging somebody else. But anyhow, it is far different than the depression and eventual acceptance that typically come later in a bear market. Further support for this bearish assessment comes from the discovery that the bull's argument is not supported historically. Only in relatively recent decades was the market reliably higher in a year's time, following occasions in which the bear market or a bear market had reached the 25% pain threshold. It is not a good sign that the bulls are basing their optimism on such a flimsy foundation. Consider what I found upon analyzing the 21 bear markets since 1900 in the Ned Davis research calendar, in which the Dow Jones Industrial Average fell at least 25%. I measured the market's one-year return subsequent to the day on which each of these 21 bear markets first fell to that loss threshold, the 25% we're talking about. Listen to this. In 7 of the 21 cases, or 33%, the market was lower in a year's time. So when they say timing the market is better than timing the market, it's a market of stocks, not a stock market, bullshit. That is the identical percentage that applies to all days in the stock market over the past century, regardless of whether those days come during bull or bear markets. So based on the magnitude of the bear market's losses to date, there is no reason to believe that the market's odds of rising are any higher now than at any other time. And of course, before we start reviewing the FOMC, a lot of us maverick economists warned about this pivot lunacy, this pivot bullshit. Among them, Mohamed El-Arian. Take a look.
And they see this news and say to themselves, maybe we got to take our foot off the neck of the economy.
Yeah, we got to work. We got to stop with this love affair with a pivot. We saw what it resulted in during the summer. If the Fed pivots, it's because we've had either an economic accident or a market accident. We should not be wishing for that because the journey to a pivot would be painful.
And that's the reality. The pivot will happen, but it's only going to happen when something breaks. After something breaks. And that's bearish. That's not bullish. If you say, oh, the Fed is going to pivot because the economy is about to collapse or something is going to break, yeah, that's not a reason to buy the stock market, buddy. Now look, I don't want to sound doom and gloom and this is, hey, wave the white flag, the stock market is dead, get out of the market entirely. You know, there are ways to make money when the market goes up, and there are plenty more ways to make money when the market goes down. That money doesn't disappear. The money that was made when the market ran higher, that money didn't disappear in a black hole. That money exchanges hands from bulls to bears. And the smartest market participants play it both ways. When we are in a bull market, they go long and they make money. And when the market changes course, they bet the other way and they make money on the downside. And believe it or not, even in a bear market, there are still bull pockets. There are still stocks making all-time highs as we speak today. We try to spot some of them at least. I try to do my best in this channel. And this is the message I want to leave you with before we start the review of the FOMC. Speaking of, let's do that. And here it is. In focus tonight. The FOMC review. No pivot. It's not going to happen. Why isn't it happening? Well, here's Jerome Powell in his own words. Take a look.
The labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched.
So A, he acknowledges that the labor market is too hot. We got the JOLTS, job openings, they went higher. He acknowledges that. And as the JOLTS continue to go higher, as the labor market continues to be tight, wages will go higher, pushing inflation higher. And some of you first-time viewers would say, hey, what's the problem with wages going higher? Wages so far are lagging inflation. And the higher wages go, the higher inflation will go, and the bigger the gap between wages and inflation will expand. He also acknowledges that inflation is too hot. Whether we look at the CPI, core CPI, PCE, core PCE, inflation remains hot. And therefore, he says at the end, yes, we're seeing inflation expectations going down and being anchored, but we cannot be complacent. No complacency. Because if they become complacent, inflation expectations will move higher again. And that is the leading stage to actual inflation moving higher. Chairman Powell also reinstated this exact point when he asked about whether inflation is entrenched or not. Take a look.
Hi, Chair Powell. Thank you for taking our questions. Gina Smiley, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So, I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage-setting process. There's a school of thought that believes that. So that's very concerning.
So what I'm really happy about is he acknowledged the recent University of Michigan Consumer Sentiment Index, which included inflation expectations. And in that survey, inflation expectations went higher again. So he acknowledged that. He saw the same thing that I saw. And he came out with clarity and boldness by saying, hey, we cannot afford to see inflation expectations moving higher again. We cannot afford to prematurely loosen the policy and let inflation expectations go higher. Take a listen.
Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done.
So now he talked about higher rates. That rates are going to be higher than expectations. Every time they go higher and higher and higher. The September survey says, it's going to be 4.7%. The October survey says 5%. The November survey would be 5.5%. And these expectations for higher rates continue to go higher and higher and higher. And note to Jerome Powell, at some point you're going to realize that to properly defeat inflation, you need to raise rates above the rate of inflation. This is how it worked in the past. It's going to take Jerome Powell a little while to catch up here, but at least he acknowledges that rates will go higher, much higher than previously anticipated. And why is that?
We're not targeting any one or two particular things. You know, our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher. And that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another, they go up, and that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So Okay.
You heard what he said. Inflation is not coming down. Matter of fact, when he looks at the data for CPI inflation, he says we are exactly at the same point 1 year ago. So far, very little progress in taking inflation down. Now ask yourself a question. Is this the right time to loosen the policy? Is this the right time for a pause? Is this the right time for a pivot when inflation is not cooperating? Or is it the time to double down and raise rates even more? This is exactly what he's going to do. And folks say, oh, maybe he's over-tightening. He's damaging my portfolio, damn it. Maybe he's going to cause a financial accident or whatever. Jerome Powell says, no, we're not over-tightening. Take a look.
But there's no, I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program that we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases. And we have some ground left to cover here.
Now he says they're not over-tightening, but he also acknowledges that there is going to be a pivot. If the recent definition of a pivot of slowing down rates from 75 to 50 or 25, if that is the definition of a pivot, then a pivot will happen. But there is a catch. Take a look.
At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected.
So he talks about the pivot. He talks about slowing down the rate of increases. But he also says, hey, we might be slowing down the rate of increases at some point, but the overall rate will go higher than previously anticipated. And Jerome Powell, I thought he did a really good job in breaking down the three conditions or three things that we should look at when we talk about a pivot or the slowdown in interest rate hikes and all of that. He broke it down to three things. Take a look.
So, what I want to do is put that question of pace in the context of our broader tightening program, if I may, and talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was and has been how fast to go. The second is how high to raise our policy rate, and the third will be eventually how long to remain at a restrictive level. So. On the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement because that really does become the important question we think now is how far to go, and I'll talk more about that. We think there's some ground to cover, but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting.
So when folks say, hey, the Fed might pivot by slowing down the pace of interest rate hikes from 75 to 50, and that merits buying the stock market by the dip, here's the problem with that. Jerome Powell is saying, you guys are just looking at one thing. I'm looking at three. You guys are looking at the pace of interest rate hikes, how fast interest rate hikes will go. I'm not really looking at that. I'm looking at the pace, how fast they're going to go. I'm also looking at number two, the level, how high interest rates will go eventually. And number three, I'm looking at the length, how long we're going to keep these interest rates high at the restrictive level. So he says, okay, you want to bargain about the pace and say I'm going to go from 75 to 50. That's all fun and games. No problem. Maybe I'm going to go to 50 in December. Sure. But at the end of the day, the question becomes how high. If you thought before that we're going to do 50 in December and then 25 in January or February and that's it, think again. We might do 50 in December if that's what you're looking for, but we're going to do 50 again in January or February, and then we're going to do maybe another 50 or another 25 and another 25. And ultimately, if you were looking for a 5% rate by the end of this, I got news for you. The rate went higher to 5.5%, or it went higher to 6%. So does it really make sense to concentrate on the pace when the ultimate level is about to be higher? Actually went higher? He did pivot today. And the pivot was the ultimate interest rate, the restrictive interest rate that everybody was assuming it's going to be 4.5%. And then 5, that's going higher. And then, of course, comes the question of how long will they keep that rate to see progress on inflation and a slowdown in the economy? That conversation comes later. And your question right now might be, hey, Maverick, but isn't the Fed risking doing too much? Doesn't Jerome Powell realize that he might end up over-tightening or doing too much if he is going higher with the rates? Here's what he said.
Follow up. You also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that that risk assessment has changed a little bit?
Well, what's happened is time has passed and we've raised interest rates by 375 basis points. I would not change a word in that statement, though.
Why is he sticking with that statement? Why does he believe that the risk of overdoing it, aka over-tightening, is a lot better than doing too little or loosen prematurely or pivot prematurely? Here's Powell once again with a clear answer. Take a look.
Trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And bingo, this is what I've been saying all along. The Fed can always cut interest rates to stimulate the economy. If there is a financial accident, if there is risk of overdoing it, if we see a lot of damage in the economy, they can always cut rates. But if they wait and do too little, wait and see, the economy is going to weaken either way, while inflation will stick higher. And to fight this sticky inflation, they will tighten. And in this case, they will tighten over a damaged economy. But if they front load all of these interest rate hikes, and I say, hey, Mr. Powell, why not just go 100 basis points? Why not just get it to the restrictive rate as soon as possible, while the economy can still absorb the shock, while we're not seeing a lot of damage in the labor market so far? Why not front load even more? Because if you do that, let's say next year the economy heads into a recession, and it is a severe one. Now you got a lot of ammo to start cutting rates and re-stimulate the economy. So do you get it now? The risk of over-tightening is a lot better than the risk of doing nothing or the risk of letting inflation go. You can always cut rates. You can always take the rate hikes off the table. But we know from history that inflation evolves into stagflation on its own, and then the next stage is a recession either way, with or without the Fed's intervention. What the Fed is doing right now is fast-forwarding the stagflation part all the way to a recession and then rebuilding the economy once again. But if they continue to wait and debate and look and see and assess, the economy will weaken either way as it heads from inflation to stagflation, and tightening then is more damaging than tightening now. I hope that this is clear. And with that, folks, we have to move on here and cover the stock market information for you. We begin with the closing of the indices today, and here we go. The Dow Industrial Average down by 505.44 points, or a decline of 1.55%. The Nasdaq is down big by 366.05 points, or a decline of 3.36%. The S&P down by 96.41 points, or a decline of 2.5%. Whipsaw day, initially the reaction was positive, and then Jay Powell spoke and killed all the hopes and dreams for a stock market rally. When we look at the massacre across the sectors of the market, all down, shame on all of them, they got slaughtered, no medals today, and the laggards were led by technology, cyclicals, and materials. When we look at the advance to decline ratios, NYSE 20% advancing versus 79% declining. The Nasdaq 29% advancing versus 67% declining. And this breadth is about to get a lot worse. On to commodities. We know that the dollar initially went down big, then it went higher again. So we might have some knee-jerk reactions here in the futures market, but we'll see how it settles tomorrow. For now, We have gains in energy across the board, be it modest gains for crude, the WTI and Brent up about 1% apiece, but we have sizable gains for gasoline RBOB, scoring gains of about 3.25%. Heating oil was also up by about 1.5%, and the party boy, natural gas, scoring gains worth over 8% for the day. And then we have softs, positive day for cocoa, cotton futures up big, over 5%, and then coffee futures also rebounding big, scoring gains for a little over 4%. And I did buy some coffee contracts in the morning today. I believe that we are in a rebound stage. We're going to see a rebound from this point on. It might not last for too long, but it's certainly worth playing. Now that we have the Brazilian elections out of the way, we will see easing of the downward pressure against coffee futures. And then we have more modest gains, almost flattish for OJ and sugar futures. Meanwhile, the loser, lumber, down about 1.25% for the day. When it comes to metals, the most sensitive commodity to the rise or decline of the dollar, right across the board, at the end of the day, the dollar moved higher, and therefore gold is down, silver down, platinum down, copper down, palladium down, everything is down. When we talk about meats, flattish activity for live cattle futures, and then we have sizable gains for feeder cattle futures worth about a little over 1%. On the other hand, lean hogs getting slaughtered today, down about a little over 2%. When it comes to grains, red across the board, with exception of soybean oil futures, scoring big gains, a little over 3% for the day. Then we have more modest gains for soybeans futures, but the story here is wheat futures down over 6% for the day, erasing the majority of the gains since Russia decided to pull out of the grain deal with Ukraine. Well, now we have the news that the deal is back on. And I told you this is the risk that you're going to assume in buying wheat futures, or the ticker WEAT, the wheat fund, because the moment Russia does the 180, these will go down. This is the risk that we assumed before getting in, and it is playing this way exactly. Moving on to options, the big casino, what's going on here? We're seeing more buying of puts than calls. We're seeing the volume all in all receding. All signs that the rally that we've seen recently in the market will indeed frizzle and reverse 180 and produce a lower low. The hottest table today was Amazon at around 2.5 million contracts traded today. A lot of weakness in Amazon recently. Look at this. Over 71.5% of the volume traded for Amazon was actually puts. People bidding for more downside in Amazon. Not calls. Unbelievable. And then we have Apple at number 2 with around 1.2 million contracts traded today. About 52% of those were puts. And then at number 3, Tesla, the souffle, at around 900,000 contracts traded today. About 53% of those, once again, puts, not calls. On to the unusual activities that took place in the options market today. We start with the ticker CVNA, Carvana. Very volatile name. It goes up big, but it goes down bigger. Somebody sees the rebound coming, and they bought the $17 calls for the expiration date, November 11, with expectations that Carvana could rebound and gain more than 22% by then. They paid around $1 a piece to enter this trade, all in all spending around $600,000. And then what about the ticker ACI for Albertsons? The name shot up higher on the Kroger deal, and as a Kroger shareholder, why couldn't Kroger wait until the crash of ACI? Why overpay right now? Because the name went down big after earnings. But somebody sees a rebound coming here, and they bought the 22 calls for the expiration date, December 16, with expectations that the name could rebound and gain more than 7.5% by then. And they paid around 50 cents a piece to enter this trade, all in all spending around $200,000. And lastly, what about the ticker Triple Qs, the Nasdaq? Well, somebody's bidding for more downside to come here, and they bought the 238 puts for the expiration date, December 30. No sign of rally, I guess, because the expectations are for the Qs to go down from this point on by more than 11% by the expiration date. And they paid around $4 a piece to enter this trade, all in all spending around $1.2 million. On to the heat map. What's going on here? A massacre, a bloodbath across the board. Nothing to see here. Some names managed to close in the green. These are exceptions, but the theme is clear. Bloodbath, everything is down. Now, is it a knee-jerk reaction? Well, it's certainly going to be a knee-jerk reaction for for some names are worthy of picking up, and I'll let the market show me tomorrow which names are worthy of picking up. My guess would be names in healthcare, the big pharma names in consumer defensives, the packaged food companies, the consumer staples, but I doubt that the reaction that we got in Apple, Microsoft, Meta, Tesla, Amazon, that these reactions are a knee-jerk reaction. Look at Tesla, for example, down over 5.5% for the day. Initially, it was positive. So what is the message here? The message says Jerome Powell will raise interest rates higher than previously anticipated. And this means these valuations have to be trimmed even more. So any name that is overvalued right now is radioactive waste. Stay away. Only pick the dips in value and names with the inflationary power. Some of these names will be in healthcare, others would be in energy. Energy got whacked today, but will the dip be picked up or not? My hunch is it will be at some point, but it will also be picked up in some of the consumer staples. Absent of that, I don't see anything else worthy of picking up here. When we move on to the heat map for the ETFs, again, a bloodbath across the board with few exceptions. These exceptions, number one, natural gas. Look at UNG and the leverage index for natural gas, BOIL, also known as BOIL, flying high. And then we also have the Chinese names, the ETFs, FXI, MCHI closing in the green, but that's because they closed before Papa Jerome started the slaughtering. My hunch is they go down tomorrow. But a notable finding here is, look at value versus growth. Sure, both in the red. Both are down, but value still outperforming growth. The IWF, for example, for growth, down over 3% for the day. The IWD for value, down just a little under 2% for the day. So again, if there is a dip that will be picked up, it's going to be in value, not in the growth cohort. Moving on to charts, and we start with SPY, the S&P 500 30-minute chart. What do we see here? Clearly, this is a nasty reversal. The chart initially blasted higher, and it regained 385.15 as support. And then what happened? A nasty reversal, erasing that move entirely, because the chart not only lost 385.15, but it also lost 379.5. That is a confirmation that we got a reversal on hand. But remember, I cautioned the bears from becoming too aggressive here until we see 373.5 lost as support for good. Because absent of that, there are still technical hopes. There are still hopes from a technical perspective, not a fundamental one, that's for sure, especially after the FOMC today. So we could see a rebound from 373.5, for example, off oversold conditions. But the confirmation for the bears would be losing that number of support. And then we're going to talk about the June bottom. Here's the daily chart for the continuous contract. And notice that in the SPY's chart, 373.5, in this chart, the equivalent is 3,720.5. So until that is lost as support, we're not going to say for sure that the bulls are dead for good. Because for now, believe it or not, the volume remains below average. The momentum indicators remain positive. Yes, they lost a lot of momentum today, but we have yet to see a confirmation. The confirmation would be losing 3,720.5, and we see a red impression in the histogram of the MACD indicator, and that will tell us that the next step is violating the June bottom at around 3,600. Now, when we look at the weekly chart for the SPX, the cash index for the S&P 500, isn't it amazing that the most accurate technical analyst for the year so far, Katie Stockton, said, hey, we're going to see a bear market rally. The bear market rally is going to take us to 3,900. And then the bear market resumes. Well, we got to 3,900. The chart stopped exactly at that number. And now it's flushing down. And it lost support number one, 3,800 gone. Of course, we have yet to see the confirmation. The confirmation would be closing the week below 3,800. The good news for the bulls, they still got 3,500 as support. We'll see what happens when we get there. Not if, but when. But you gotta pay close attention here to the MACD indicator. Look at where it is right now. We're about to have a positive crossing in the MACD indicator on the weekly chart of the SPX, indicating the bearish momentum is over and a new bullish momentum is about to start. However, if that crossing doesn't happen, we see the MACD curling its way down, producing longer red impressions in the histogram. Oh boy, that will produce a massive flush down. And I don't think that 3,500 will hold in that case. Keep that thought in mind. We're going to revisit it again in the NASDAQ. Speaking of, here's the 30-minute chart for the Qs. Again, the market managed to shrug off yields rising again. Tesla crashing. The resignation of Liz Truss. Snapchat crashing. Chairman Xi being re-elected for life. The crash of Google, Meta, Amazon. That didn't matter for the NASDAQ because it was all in that the pivot will happen. Well, now the pivot is not happening, so the chart has to readjust. And now it lost the June bottom for good. It lost 269.29, and the next support would be 261.69, which will likely not hold. You know why? Because the recalculation is not about, oh, the pivot didn't happen. It's not only that, but hey, now we got to pay close attention to the crash in Amazon, Meta, Google, Snap, Tesla, the rise in yields, the geopolitical problems in China, in UK, and all over the place. And that will exacerbate the move to the downside. Psychologically speaking, a lot of folks who bought and bought and bought since the beginning of October, now they capitulate and they realize that they're wrong. And they're all rushing to the exit at the same time. What do you think that will produce? Here's a daily chart for the continuous contract for the NASDAQ. Again, the June bottom is gone, but we have yet to see the confirmation with a weekly closing below the June bottom, which stands at 11,058.5. The volume is rising higher. The momentum indicators lost a lot of ground. They're about to cross, at least in the MACD, and it will produce negative impressions on the histogram, indicating the June bottom is gone for good. The reverse head and shoulder is not going to happen, and the NASDAQ is about to flush down. How low will it go, Maverick? Here it is. We zoom out, same chart, weekly chart this time around. We see the next target down about 11 to 12% at 9,736. Now pay attention to the MACD indicator because it was about to cross to produce positive impressions in the histogram, saying that the NASDAQ is done with the bearish momentum and on to a new, fresh, bullish momentum. But what if that cross doesn't happen? What if the MACD curls its way down, producing longer red impressions in the histogram, and the cross never happens? Well, we've seen this case numerous times before. The last time around was earlier this year, and that failure to cross produced a downside in the chart worth about 27%. So if you see the MACD curling its way down, and it becomes clear that the crossing is not going to happen on the weekly chart, you got to double down on the puts, because these kind of opportunities don't happen. They happen once in a decade, once every 8-6 years. You're not going to get this opportunity another time, maybe. So if you see the MACD on the weekly chart curling down and the crossing is not going to happen, it is time to double down on the puts. And notice that the VIX is low right now, meaning puts are cheap. So you do the math and look at the charts individually. You don't have to short the NASDAQ alone. You can look at Microsoft, for example. Here's a weekly chart. We can see that the crossing is probably not going to happen in Microsoft. We're seeing longer impressions in the histogram of the MACD, longer negative impressions, and it appears that the chart has lower lows to go. Sure, the weekly closing is not here, but do you really need to see more? Because if this plays out, Microsoft is going to go down by, about another 19%. I don't want to miss on that downside. What about the IWM, the Russell 2000, 30 minutes chart for the small caps? We talked about a reverse ABC pattern yesterday. It played out. The chart opened down initially, and then when the bulls got their bone thrown by the Fed in the statement of the FOMC, the Russell shot up higher. It recaptured 183.25 as support, but that got reversed right away, and the chart closed at the lows of the day. So this is a reversal with higher volume. The next support we have is 174.22. And the IWM has a lot of catch up to do here if it wants to go south, because it has been outperforming the SPY and the Qs. So if you do believe that the market all in all is going down, you're better off buying puts on the IWM than, say, the NASDAQ or the SPY, because there is more room to the downside for the IWM. And here it is, the most important chart for the day, the Dixie, the dollar index. What's going on here? Initially, it went down big, but then came Jerome Powell with the conference and the hawks all over the place. The king of hawks. And the dollar shot up higher. It recaptured 111.5 as support. Now we're looking at 113 as resistance. But most importantly, the negative divergence on the RSI is no longer. And guess who predicted all of this? The answer is, how about the old man gold? Here's a daily chart for gold. If the dollar was about to go down and Powell was about to come out dovish, we should have seen gold crossing above 1,671. But it didn't. As if it's been saying, hey folks, the dollar is not going down, it's going to go higher. Powell is not going to come out dovish, he's going to come out hawkish. Gold predicted all of this ahead of time. And if you're shocked by the downside in gold, you should have known ahead of time when Cramer gave it the kiss of death. When Cramer about 2 months ago said it is the perfect time to buy gold. That was the moment. You should have bailed out immediately. And here is UK oil, Brent oil, daily chart. What's going on here? It is playing out the ABC pattern, but boy, if the dollar continues to surge higher impulsively, oil is going to have a hard time blasting higher. But again, oil has really strong tailwinds behind it, Be it the tensions between Saudi and Iran, be it the price cap on Russian oil, be it the shortage of supply, and the inventories being low all over the place. The tailwinds are here. Refilling the SPR, that's another one. But if the dollar continues to surge impulsively, we could see a pullback in energy. And then it's up to you. Reassess, look around, and maybe then it will be worthy of buying the dip in oil. We'll see what happens one step at a time. But here's a daily chart for the 10-year yield, another important indicator. And today, it blasted higher above the consolidation range. And again, for now, the bulls theory is playing out of higher highs and higher lows. The head and shoulder formation that bond bulls, equities bulls, / yields bears were hoping for, it doesn't look likely right now. Look at the 2-year yield, by the way. Do yourself a favor. That thing is about to blast higher. And so will the 10. Maybe it will be lagging in terms of the momentum, but JP made it clear that yields are going higher. Rates are going higher. So for now, when we look at the TLT, a daily chart, which ABC is now having the upper hand? It's bond bears, the reverse ABC, have the upper hand right now. And if it does play, we're going down to 87.94. What about the VIX? Everybody was asking today, what's going on with the VIX? Why isn't the VIX blasting significantly higher? Well, this is a 4-hour chart for the VIX. And as you can see, the support is at 24.29. We never even got there. Yet we have positive momentum in the MACD indicator, and we have the hour side gaining momentum, moving higher again. So if what we got today in the equities market, the downside continues, and the likelihood right now it will, sooner or later, market participants will realize that we have more downside coming, and they need to hedge more. So the VIX eventually could blast higher. But for now, as a trader, you must take the opportunity while the VIX remains low by hedging your portfolio, by buying these puts while they're still cheap, because the VIX might be trading a lot higher in a week or so, a month or so. When the VIX is down, puts become cheaper. The premiums go down. But once the VIX blasts higher, the opportunity is gone. You're going to see the premiums for puts accelerating, and they're going to become too expensive at some point. So the opportunity is to buy them right now. And here's Apple, 15 minutes chart. What's going on here? The bear flag played out. The chart lost 150 as support, but then came the false hope of a pivot. I think Jerome Powell trolled everybody. He gave the statement out that a pivot might happen, and the pumpers came out on TV right away jerking off, and then what do you know, the pies came right in the face during the conference. And Apple lost 150 once and for all, and it went down to close the gap at 145, as we have anticipated ahead of time. And I see more downside coming for Apple here. Let's zoom out. We see that the resistance would be 145. The support would be filling another gap downside or downstairs at around 138.79. Tesla, 30 minutes chart. What's going on here? The bear flag did play out, and the chart lost 224.39, but then came the knee-jerk reaction. It regained that level of support again, but then comes the confirmation, once and for all, that this is a reversal, folks. Not only the chart lost 224.39, but it lost 217.88 by the end of the day. And for now, the next support stands at 206.86. And lastly, Bitcoin, tulips, what's going on here? On one hand, the chart made a lower low in the pattern. The chart did break the trend line. On the other hand, it did not break below 20,000. So long as the chart trades above 20,000, crypto bulls have the advantage, not the bears. Now, I don't know where Bitcoin is trading right now as I speak, because it might be below 20,000. At the end of the day, a weekly closing below 20,000, and I know Bitcoin trades continuously, but a closing by Friday below 20,000 will seal the deal that this thing is going to go down, and it's not immune. It's going to follow the equities market too. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? How about initial jobless claims? And then we have productivity, unit labor cost. This will be important for the Fed. And then we have the services PMI. And last but not least, factory orders. And with that, folks, once again, thank you for your support. This is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. But most importantly, don't fight the Fed. Good night.
Oi! No fighting. No f***ing fighting. No fighting. No f***ing fighting!